Have you ever wondered why crypto crashes happen so suddenly? Many investors enter the market expecting quick profits and easy success. Unfortunately, markets can change direction when people least expect it. A crypto crash can erase months of gains within a few days. Some investors panic and make costly decisions during market downturns. Others remain calm and protect their money through smart planning. Understanding risk is the first step toward avoiding major losses. Every investment carries uncertainty, regardless of market conditions. Crypto assets are especially known for their extreme price volatility. Prices can rise dramatically and fall just as quickly. Successful investors prepare for bad times before they arrive. Preparation often matters more than predicting future market movements. One common mistake is investing money needed for daily expenses. Financial pressure can force investors to sell at terrible prices. Always separate investment funds from essential living expenses. This simple habit creates flexibility during difficult market periods. Another mistake involves putting all funds into one cryptocurrency. Concentration increases risk because a single failure affects everything. Diversification helps spread risk across multiple investment opportunities. Different assets may react differently during market correction. Smart investors rarely depend on one project for success. Research is another important tool for protecting your capital. Understanding a project's purpose helps identify potential weaknesses. Strong fundamentals often matter more than short-term excitement. Many people buy assets simply because others recommend them. Following crowds can become dangerous during market euphoria. Popular investments are not always good investments. Learning independently improves decision-making and reduces emotional reactions. Emotional investing often leads to unnecessary financial losses. Fear and greed frequently drive irrational market behavior. During bull markets, greed encourages investors to take excessive risks. During crashes, fear pushes investors to sell too quickly. Successful investors develop strategies before emotions take control. Having clear rules reduces uncertainty during stressful situations. Risk management should always be part of every investment plan. A solid plan helps investors stay focused during volatility. Setting realistic expectations is also extremely important. Crypto markets do not generate profits every single day. Temporary losses are a normal part of investing. Accepting this reality helps maintain emotional stability. Patience often separates successful investors from unsuccessful ones. Long-term thinking reduces the impact of short-term price swings. Knowledge becomes a powerful shield during market crashes. Investors who understand risk usually make better decisions. In the next part, we will explore practical strategies to protect your portfolio during a crypto crash. Protecting your portfolio begins with creating a clear exit strategy. An exit strategy defines when you will reduce or sell positions. Many investors only think about buying and ignore selling plans. This oversight can become expensive during a sudden market collapse. Setting profit targets helps lock in gains before conditions worsen. Taking partial profits reduces exposure while preserving opportunities. You do not need to sell everything at once. Gradual selling can lower risk without abandoning the market completely. Stop loss orders are another useful risk management tool. These orders automatically sell assets when prices reach certain levels. Stop loss strategies can help limit losses during sharp declines. However, they should be used carefully in volatile markets. Cash reserves provide valuable protection during uncertain periods. Keeping some funds uninvested creates financial flexibility. Cash allows investors to respond calmly to market changes. It also creates opportunities when quality assets become cheaper. Many experienced investors maintain emergency reserves for this reason. Avoid borrowing money to invest in cryptocurrencies. Debt increases pressure and magnifies potential losses. A market crash can become much more damaging with leverage. Leverage may increase gains during rallies. Unfortunately, it can also accelerate losses during downturns. Some investors lose entire accounts because of excessive leverage, and preserving capital should always take priority over chasing profits. Security is another important aspect of protecting investments. Use strong passwords for exchange and wallet accounts. Enable two-factor authentication whenever possible. Protecting assets from hackers is just as important as market analysis. Diversifying storage methods can reduce certain security risks. Some investors store long-term holdings in private wallets. This approach limits exposure to exchange-related problems. Regular portfolio reviews help identify growing risks. Market conditions can change significantly over time. Assets that once appeared strong may become weaker. Reviewing investments encourages informed and timely decisions. Avoid making decisions based solely on social media trends. Online excitement often increases near market peaks. Influencers may not always share balanced information. Independent research remains one of the best defenses. Focus on facts instead of emotional headlines. Staying informed helps investors recognize warning signs earlier. Market awareness improves confidence during uncertain periods. Every protective measure adds another layer of financial safety. Small precautions can prevent major losses in difficult markets. In the next part, we will discuss how to stay calm and avoid panic during a crypto crash. Staying calm during a crypto crash is often harder than it sounds. Prices can fall rapidly and create intense emotional pressure. Investors frequently see fear spreading across news and social media. Negative headlines can make every market decline seem catastrophic. Panic is one of the biggest threats to long-term success. Fear often causes investors to abandon well-planned strategies. Emotional decisions rarely produce the best financial outcomes. Successful investors understand that volatility is part of the market. Market cycles have existed throughout financial history. Periods of growth are often followed by periods of decline. Understanding cycles helps reduce unnecessary anxiety. Temporary price drops do not always indicate permanent failure. Focusing on long-term goals can improve decision-making. Long-term investors usually pay less attention to daily fluctuations. Constantly checking prices can increase emotional stress. Monitoring markets every minute rarely improves investment performance. Taking breaks from charts can help maintain perspective. Clear thinking becomes easier when emotions are under control. Confidence comes from preparation rather than predictions. Investors with solid plans tend to react more rationally. Reviewing your original investment thesis can be helpful. Ask yourself whether the reasons for investing still exist. If fundamentals remain strong, panic selling may be unnecessary. Rational analysis should guide actions during market uncertainty. Building patience is an important investing skill. Patience allows investors to avoid impulsive reactions. Many successful investors endured multiple market downturns. They survived because they focused on long-term objectives. Comparing yourself to others can create unnecessary pressure. Every investor has different goals and risk tolerance. Avoid making decisions based on someone else's results. Financial success is rarely achieved through emotional competition. Keeping a written investment plan can provide clarity. Written rules help reduce confusion during stressful moments. These rules act as a guide when emotions become overwhelming. Discipline is often more valuable than market timing. No investor can predict every market movement perfectly. Trying to time every rise and fall is extremely difficult. Consistent risk management usually delivers better results. Learning from previous mistakes strengthens future decision making. Every market experience provides valuable lessons. Investors who learn continuously become more resilient. A calm mindset can protect both money and confidence. Emotional control is a powerful advantage during market crashes. In the final part, we will explore how experienced investors prepare for future crypto downturns. Experienced investors know that preparation never truly ends. Every market cycle offers opportunities to improve investing skills. The goal is not to avoid every loss completely. The goal is to prevent losses from becoming devastating. Capital preservation should remain a top priority. Protecting your money allows you to stay in the game longer. Investors who survive crashes can participate in future recoveries. Recovery opportunities often appear after periods of extreme fear. Market downturns can create attractive buying opportunities. However, patience is necessary before taking action. Rushing into trades can increase unnecessary risk. Careful analysis should guide every investment decision. Building a diversified portfolio remains a powerful strategy. Diversification reduces dependence on any single asset. Strong portfolios are designed to handle uncertainty. Maintaining cash reserves improves financial flexibility. Liquidity can become extremely valuable during market stress. Investors with cash often have more options available. Continuous education strengthens long-term investment performance. Markets evolve, and investors must evolve with them. Learning about technology can improve investment understanding. Knowledge helps identify both opportunities and risks. Following credible sources supports informed decision-making. Reliable information is essential during volatile periods. Avoid reacting to every rumor or prediction. Speculation often creates confusion rather than clarity. Focus on evidence instead of market noise. Building good habits can improve investment outcomes. Consistency is often more effective than chasing quick gains. Small disciplined actions produce significant long-term results. Risk management should remain active in every market condition. Bull markets and bear markets both require careful planning. Successful investors respect uncertainty at all times. Overconfidence can become dangerous after large profits. Humility encourages smarter and more balanced decisions. Every investment should have a clear purpose. Random decisions often lead to random results. Strategic investing requires patience and discipline. Long-term success rarely comes from emotional reactions. Investors who remain calm gain a valuable advantage. Crashes can be difficult, but they are not permanent. Financial resilience grows through experience and preparation. Smart planning reduces fear during market downturns. The best defense against a crypto crash is preparation before it happens. By managing risk wisely, you can protect your capital and invest with greater confidence.